So in this video, we are going to walk through some private equity playbooks that you can apply to your great business, whether you're scaling from scratch or even if you're an enterprise and you're thinking about, well, how is it that those private equity folks do things? How do they think about building businesses? Now, I want to democratize what I've learned working in private equity firms where we build very large businesses in a compressed amount of time and see how you can apply that to your business. And specifically what we're going to do is we're going to walk through three different models that to help you multiply the value of your business and think about getting into the grown-up leads of business building, which is thinking about shareholder value and enterprise value and all of that great stuff. If we haven't met before, my name is Thomas Cornwall. I run Open Equity, where we invest in and build businesses. But also, as the name suggests, we do it in a very different way. It's based on my experience as a founder and working with private equity firms and seeing, look, there's an opportunity to do something better here, to invest and support and help scale companies based on some of the playbooks that myself and my team have learned. If you're interested, you want to jump on a call and see if we might be a good fit to invest in or acquire or partner with you, head down below. There's some links and you can jump on a call with the team and we'll have a great conversation. So let's talk through these three models. So first model, buy and build. Now, why would you want to do this? Well, ultimately, when you're scaling a company, you can do it in two ways. You invest money into your marketing, into your sales, getting customers through the door, servicing them, getting a profit and beyond. But just thinking about it, that takes the time that it takes. It takes a certain amount of time and the sales cycle to acquire a customer. And you can typically only do it, just depends on the velocity of which you can acquire customers organically. Building through acquisition means that actually you might be able to buy hundreds or thousands of customers at a time. You might be able to build a whole new service line that would otherwise be impossible or very difficult to start from scratch and require a lot of investment. You might be able to buy into a new geography, which is something I've done a few times where we may have a company that's based in, say, Europe, but then we look about buying a company in the US, often happens vice versa. Or equally, I've had European companies where we've bought companies in the Gulf or other markets to allow us to then build out groups. It's a great way to grow, building through acquisition. As well, the thing that's often in people's mind is how to get the funding. And this really plays to having a clear investment thesis if you're going to go through doing a buy and build. That means taking a top-down look at your market or your industry. With great buy and builds, it really starts with that good vision of what it would be if we could consolidate all of these things together. And if we can consolidate that together, why that would be a really valuable group. And then it's a case of actually getting on with it, of going through the acquisition, having a standard deal structure, being disciplined about your integration plans and seeing it all through. So to give you an example with a buy and build, one that I was involved in years ago, we started with two mid-market companies. So it was in business services, so doing back office services, so like payroll and accounting and tax, loads of things that companies just don't want to do. But we saw that actually it was a massive market because companies don't want to do it. It's therefore a massive market. We could then go around, find all of these accountancy and payroll and tax compliance and all of these things globally. We could hoover them all up. We could integrate them all together. There'd be some cost savings through the integration. And by virtue of that, that company was worth 1.75 billion at the exit, was bought by a large private equity firm, and they took it beyond. Second thing we're talking about is public shells. So this is where you take a company public and then you use the equity, the shares in the public company to start buying up other businesses. And the thing with this is when companies are public, because the shares can be freely traded, i.e. there's liquidity, so you can buy and sell very easily. Investors like that because investors like the idea of being able to get out quickly if something's wrong, unlike a private company where you typically have to hold on to the shares and it's a bit opaque about what the value of the shares is. So an example of a building through acquisition with a public shell is WPP. WPP was started by Sir Martin Sorrell. Well, actually what he did is he bought wire and plastic products. He then used that public shell with a thesis of consolidating the advertising industry to go off and do big deals with companies like J. Walter Thompson and Ogilvy and beyond, and ultimately created a super valuable group. And a group that's actually disproportionately more valuable, or got to the point at its heyday, disproportionately more valuable than the thousands of very, very small players. I used to run a marketing agency years ago. A lot of the owners would talk about creativity and how creative they were. And I kind of thought to myself, well, there is a creativity and there is a beauty in business building. And actually, maybe if some of the creativity was applied or thought to applying to building groups or building the value of companies, being able to have a bigger impact in the world, that would be a great thing. So WPP is one example, but there are thousands of examples across industries where someone started with a public company. They've had a philosophy or a point of view that they've told to investors. They've sold that equity story to the world. And as a result, people invest in that and go beyond. And you see this all the time. Whether you look at Jensen Huang in NVIDIA telling us a story about the fourth industrial revolution and why you should buy into that, whether you hear it from someone like Nikesh Arora in Palo Alto Networks, super successful CEO who's told us a story about cybersecurity and the need for cybersecurity expanding. And by having a public company, he can then go on an acquisition spree and start hoovering up some of the smaller, more private companies and then build a much more valuable group by virtue of the fact that it's public. Investors love liquidity. So public shells, really, really great idea, particularly if you've got a long-term vision. I meet some people who think about taking a company public just as a flip. Typically, it's a bit naive because when you take a company public, you typically have to promise what's called a lock-up period. So that might be 12, 24 months where the key shareholders hold on to the business, because investors are skeptical if the key people are selling the shares when the company goes public, then, really what's that saying about the future? But if you've got a long-term vision, if you want to build through acquisition, and if you want to use investor capital, taking a company public is a great way to start. There are many exchanges where you can do that, normally lower markets as well as the main markets and key geographies. Now, the third thing I want to talk about then is mergers. When we're talking about mergers, this is a great idea, particularly for a small or medium-sized business, because if you can group a few companies together, all of them will be more valuable than the sum of the parts. Now, let me give you an example. I spent a lot of time building companies in the space that's called digital transformation, working with enterprises and governments to transform the business, to inject technology, to help them build new products and services, launch new ventures, that kind of thing. Now, very naturally, in terms of a program, you'll have about 5 or 6 different companies do different things. Someone does some strategy, someone does some design work, someone does some product development, someone then does some engineering and beyond and so on. Now, if you are a bit part in that and you typically work with similar customers or similar suppliers, it would make sense to actually group that together. And you could say, well, rather than you being a design firm or rather than you being a software engineering firm, you could suddenly say, actually, we do the full service. And when you look at the larger companies who've maybe built through acquisition or just happen to be the market leaders, they'll typically offer an end-to-end or a full service offering. And that really is the holy grail, because most companies don't want to have to manage lots and lots of different smaller suppliers. They actually rather work with somebody who can do the whole thing. Now, what I find that's quite surprising, I think I've had about 5 calls with owners this week. They've all said the same thing, which is essentially, everyone wants to build the value of their company. Everyone wants to have a bigger impact. Everyone wants the company to be more valuable and allows them to perhaps have an exit or have a liquidity event that can create and secure some wealth for them. But what they don't realize is that every other owner is also thinking the same thing in your industry. And so with a merger, you can then take the lead and you can say, what I'm going to do is I'm going to take my existing company, we're going to put together a holding company, and we're then going to work together through these 4 or 5 companies to form a group. And that can sound quite complicated, but it doesn't need to be, because essentially what you're saying is we're going to create a group structure, which is just setting up a simple entity. And then we're going to have agreements with all of the different companies within that merged organization, which is essentially saying we as a group are going to offer a load of services. So maybe accounting or HR or payroll or even marketing. And that might be something that each individual company wouldn't be able to invest in, but by virtue of everyone kind of paying for it, and those shared services then become accessible. Everyone then is able to run their business as a simple way. And now that you have a group, it's of course more valuable. And I would highly, highly encourage you to think about how you could form a merger in your industry by setting up a group, having a good story about what it is that group's in. So case in point, one that we're doing now in the education space or education technology space, we partnered with one owner who ran a mid-sized company who was offering services around a particular niche or topic, and realized actually if we could put together it with 4 or 5 owners that he knows who run different companies, talks to all the time, who all face similar scaling challenges, under a good story about the future of education and how we are transforming this, then everyone is better off if we can offer them shared services. And we can also pave a path towards an exit to a private equity firm or to a larger trade buyer. What's great about them is you'll find that the company is probably 2 to 5 times more valuable by being part of this group, because larger companies are just more investable. They're more stable. Investors like them. PE firms start getting involved. Trade buyers getting involved. And the thing that makes them fall apart, of course, is people. The holy grail situation really is if you have 4 or 5 owners who already know, like, and trust each other, who can actually sit down and start to form this and put this together. Really, to sum up then, how it is that you can multiply the value of your company, how you can do it in a compressed way. So we've got 3 models there. Then the first is the buy and build, building with a public shell. And the third thing is then merging companies together. Now, what really makes the difference is having a clear plan. So if you've gone through this video, you thought, I want to do a buy and build, or I want to do a public shell, or I want to merge companies together. Let's talk it through. Let's build a plan. And below here, you will see a link. You can head over to us at Open Equity. You can apply, you can jump on a call with our team, and we'll put together a plan, whether you want to buy and build or take the company public or merge companies together, and we'll give you some certainty about how you might go about that. So head below and click on that. Hope you find this useful. I hope this started to allow you to think about different ways in which you can scale your company and go off and implement it. And I'm sure you'll be really successful. Until next time, see you soon.